Okay, so you finally did it. You opened your first brokerage account. Maybe it was Fidelity, maybe Schwab, maybe Robinhood. Doesn't matter. The point is, you did the thing most people never actually do. And now you're staring at this dashboard thinking, okay, now what? Because nobody tells you this part. Here's what happens to almost every single new investor, and I mean almost everyone. You open the account, you transfer your first $500 or $1,000, the money shows up, and then this feeling hits you like a wave. You want to buy something right now, today. Maybe it's a stock you've been watching. Maybe it's something you heard about on a podcast. Maybe it's whatever's trending on Reddit or TikTok that week. And I completely understand that feeling. It feels like I have the account, I have the money, the whole point was to invest it, so why am I just sitting here? Here's the hard truth. That urge, that itch to just buy something immediately is one of the most dangerous feelings in investing, and acting on it is the #1 mistake that new investors make. Let me show you exactly what I mean. My friend Sarah opened her Fidelity account in early 2021. She had $2,000 saved up, felt great about it, and on day one, she put everything into GameStop. You probably know where this is going. Within 3 weeks, she'd lost over 60% of her money. Now, that's an extreme example, but I know people who lost money on perfectly normal stocks just because they rushed in without a plan. They bought something because it felt like the thing to do, not because it made sense for their situation. The stock market doesn't reward speed. It rewards patience and strategy. And the most important thing you can do in the first week after opening your account is actually nothing. Take a breath. Don't touch it yet. Because before you buy a single share, there are 3 things you need to set up. And I'm going to walk you through all 3 right now. Every finance video on YouTube is about why you should invest or how the stock market works or what index funds are. But the moment you actually have an account open with real money in it, the content just stops. So today, I'm filling that gap. This is the exact step-by-step playbook for what to do in the first 30 days after opening your account. And I'm going to save you from the mistakes that cost most new investors not just money, but years of progress. Stay with me, because what I'm about to cover in the next few minutes is something I wish someone had told me the day I opened my first account. It would have changed everything. The very first thing you need to do is figure out your actual investment number. Not how much you want to invest someday, how much you can invest every single month, consistently, without messing up your regular life. This is what's called your investment budget, and most people skip this step entirely, which is why they end up either not investing enough, or worse, investing money they actually needed for rent or an emergency. Here's a simple formula that works for most people in their 20s and 30s. Take your monthly take-home pay, subtract your fixed expenses, rent, car payment, insurance, subscriptions, then subtract your variable expenses, groceries, gas, eating out, entertainment. Whatever's left, that's your investable surplus. Now here's the rule. Never invest more than 80% of that surplus. Always keep 20% as a buffer for unexpected expenses. So if your surplus is $400 a month, your investment budget is $320. Why does this matter so much? Because the biggest threat to a new investor isn't a market crash, it's life. A car repair, a medical bill, an unexpected trip. If you overinvest and then have to pull money out within 6 months, you're not just breaking even, you're losing to taxes and potentially selling at a bad time. Know your number before you buy anything. Write it down, make it real. And here's the thing most finance channels won't tell you. It's okay if your number is small. $50 a month is better than nothing. $25 a month, still better than nothing. The habit matters more than the amount when you're just starting out. Once you know your number, then comes the fun part. What do you actually buy? And this is where I see so many people go completely off track. They think more complex equals more profitable. They think they need to pick individual stocks and build some sophisticated portfolio. They're wrong. And in the next section, I'm going to show you the exact simple framework that beats most professional investors, with proof to back it up. Don't skip this next part. It's the most important thing I'm going to say in this entire video. All right. Let's talk about what to actually put your money into. And I'm going to give you the honest answer, not the exciting one. The honest answer is, for most people starting out, you should buy exactly one thing: a total market index fund or an S&P 500 index fund. That's it. I'm serious. I know that sounds almost too simple. You were probably expecting me to talk about growth stocks, dividend plays, sector rotation, something with a little more strategy to it. But here's why simple wins. Vanguard published a study tracking actively managed funds, meaning funds where professional analysts are paid full-time to pick the best stocks, versus the S&P 500 index over a 15-year period. The result? Over 92% of actively managed large-cap funds underperformed the S&P 500. Let that land for a second. Professional fund managers with teams of analysts, Bloomberg terminals, and decades of experience, 92% of them couldn't beat a simple index fund that just tracks the market. So why would you, as a beginner with a $500 account, try to do what professional investors can't consistently do? For most new investors, the right starting point is one of these three: VOO, Vanguard S&P 500 ETF, FSKAS, Fidelity Total Market Index Fund, or SWTSX, Schwab Total Stock Market Index. All three are diversified across hundreds or thousands of companies. All three have extremely low fees. We're talking 0.03% to 0.04% annually. And all three have delivered solid long-term returns that beat the majority of professional funds. Pick one that matches your brokerage. If you're at Fidelity, use FSKAS. If you're at Schwab, use SWTSX. If you have Vanguard or any broker with ETF access, use VOO. Buy your chosen fund. Done. That is a complete, legitimate investment strategy that will outperform most people trying much harder than you. Now here's the step that most people skip, and it's the one that actually determines whether you'll still be investing 2 years from now. Automate it. Set up an automatic recurring investment on a set date every single month. Whatever your number is, $50, $200, $500, set it to transfer from your checking account to your brokerage and buy your index fund automatically. This is called dollar cost averaging, and it's one of the most powerful concepts in personal finance. Here's how it works. When you invest the same amount every month, regardless of market conditions, you automatically buy more shares when prices are low and fewer shares when prices are high. Over time, this averages out your cost per share and removes the emotion from the equation entirely. Because here's the thing, the biggest enemy of the average investor is not the market. It's themselves. It's the urge to stop investing when the market drops because it feels scary. It's the urge to invest extra when the market is up because it feels exciting. Automation eliminates both of those urges. The investment happens whether the market is up, down, sideways, or in a full-on panic. You don't have to think about it. You don't have to feel good about it. It just happens. Fidelity and Schwab both make this incredibly easy. On Fidelity, go to Accounts and Trade, then Transfers, then set up a recurring transfer. On Schwab, it's under Accounts, then Automatic Investing. It takes about 5 minutes to set up, and then you genuinely never have to think about it again. Warren Buffett has said repeatedly that most individual investors would be better off never looking at their portfolio and just automating a monthly index fund. That's not me oversimplifying. That's literally the advice of the most successful investor in history. I want you to do something right now while you're watching. Open your brokerage app, go to the automatic investment or recurring transfer section. Just look at it. Don't set it up yet if you're not ready. Just see where it is. Because the number one reason people don't set up automation is not that it's hard, it's that they close the video, intend to do it later, and then life happens and it never gets done. You're already here. The account is already open. This is the moment. Drop a comment below that says automated when you set it up. I want to see those comments. It genuinely makes my day when someone in this community takes that step. Now let's talk about something that every new investor gets wrong in the first few months, and it's costing people thousands of dollars without them even realizing it. Here's a behavior that kills more investment returns than almost anything else: checking your account every day. I know it feels responsible. You're being diligent, staying informed, watching your money. But what actually happens when you check every day is this. You start reacting. The market drops 2% one Tuesday. You feel anxious. You think about selling. Maybe you sell just to be safe. The market goes back up Thursday. You feel like you missed it. You buy back in at a higher price than you sold. That cycle, sell low, buy high, is the exact opposite of what you want, and studies show that investors who check their accounts daily make up to 3 times more trades than people who check monthly. More trades means more fees, more taxes on short-term gains, and worse returns. The research is clear on this. The less you look at your portfolio, the better it tends to perform. Not because ignorance is good, but because the market's short-term noise makes you do things that hurt your long-term results. Set a rule for yourself right now. You will check your investment account once a month. That's it. Pick a date, maybe the first Sunday of every month. Look at it then. Do not look at it any other time. In the next section, I'm going to cover the 3 things you should actually be doing with that monthly check-in and the one thing almost everyone gets wrong about rebalancing that could be silently dragging down your returns. Okay, so once a month you open your account. What should you actually be doing during that check-in? 3 things. Only 3. Number 1, confirm your automatic investment went through. Just verify the transfer happened and the shares were purchased. Takes about 30 seconds. Number 2, note your total balance. But here's the key, do not react to it. If it's up, great. If it's down, also great, because you're buying more shares at a lower price next month. Your only job is to observe, not act. Number 3, once a year, not every month, once a year, check if your portfolio has drifted significantly from your target allocation. Let me explain what that means. If you started with 100% in an S&P 500 index fund, your allocation is simple. But if you ever add bonds, international stocks, or REITs to your portfolio, your percentages can drift as different assets grow at different rates. A basic rule, if any single holding has drifted more than 5 percentage points from your target, rebalance. Sell a little of the thing that grew too much and buy a little more of what fell behind. The most common mistake I see, people rebalancing every single month. Every time the market moves, they're adjusting. What this does is generate unnecessary trades, short-term capital gains taxes, and transaction friction that quietly bleeds away returns over time. Rebalance once a year. That's the sweet spot that most financial planners recommend for a beginner portfolio. Set a calendar reminder for your account anniversary and do it then. The rest of the time, hands off. Here's the part of investing that almost nobody talks about because it doesn't make for exciting content. The first year is going to feel like nothing is happening. Your balance might go up a little, it might go down a little. You might look at your account after 6 months and think, I've been doing this for half a year and I only have $200 more than I started? What's the point? This is the most dangerous moment for new investors. This is when people quit. And quitting at this point is like leaving a cake in the oven for 20 minutes, taking it out because it doesn't look done yet, and then wondering why it never turned into a cake. Compounding doesn't show up in year 1. It barely shows up in year 2. It starts becoming noticeable around year 5. And between years 20 and 30, it absolutely explodes. Let me give you a specific example with real numbers. If you invest $300 a month starting at age 25 at an average annual return of 9%, here's what your balance looks like. After 5 years, roughly $22,000. After 10 years, roughly $56,000. After 20 years, roughly $200,000. After 30 years, roughly $545,000. After 40 years, over $1.4 million. You contributed $144,000 over 40 years. The market turned it into $1.4 million. That extra $1.25 million, that's compounding. That's the cake being done. But here's what that chart doesn't show you. For the first 5 years, it looks like almost nothing is happening. The people who quit in year 2 never see the explosion at year 25. You are planting a tree. The tree looks the same every day for years, and then one day you look up and there's shade everywhere. Stay in the game. That's the whole strategy. I want to be real with you for a second before I wrap up. You're going to make mistakes. Almost everyone does when they're starting out. Maybe you'll buy a hot stock once. Maybe you'll panic sell during a dip. Maybe you'll overinvest 1 month and have to dip into your investment account for an emergency. That's okay. That doesn't mean you're bad at this. It means you're human. The difference between investors who build real wealth and everyone else isn't that successful investors never make mistakes. It's that they don't let those mistakes stop them. They stay consistent. They learn, they adjust, and they keep going. Every dollar you have invested right now is working for you. Every month you stay consistent, you're lapping everyone who's still thinking about investing someday. You already did the hardest part. You opened the account. Now you just have to not get in your own way. Here's your action plan from this video. 3 things in order. 1. Figure out your monthly investment number using the formula I gave you in part 1. Write it down today. 2. Pick your index fund, VOO, FSKAX, or SWTSX, depending on your brokerage. That's your starting investment. 3. Set up automatic investing for that amount, recurring monthly. Do this before you close this tab. If you're watching this and you have not opened your account yet, I have a whole video on why you never feel ready to invest and how to break through that. I'll link it right here. Watch that one first, then come back to this one. For everyone else, drop "first purchase" in the comments when you make your first buy. I read every single comment in the first 24 hours, and I want to celebrate with you. If this video helped you, please share it with one person you know who just opened an account or is thinking about it. You might not realize how much it means to someone to have a clear roadmap when they're starting out. Subscribe for the next video. I'm breaking down exactly how to handle your first market downturn without panicking, because trust me, it will happen. And what you do in that moment will define your entire investing future. See you in the next one. Stay patient, stay consistent, and let the market do its thing.